Welcome to All Things Financial, Trey Peterson and Yelisey Coots. And today, season 2, we are talking about awkward questions to ask your financial planning advisor. Join us for all the things that you've wanted to ask, but maybe you were too scared to ask them. Ready, set, go. Welcome to All Things Financial, Trey Peterson and
Yelisey Coots. Probably
going to be the best one yet. We are talking about nerve-wracking questions to ask your financial advisor. You know, one of the things I hear so often is, you know, I've always wanted to ask this, but I'm scared of the answer. Or, you know, I've never asked this to my advisor, but being that we're getting a second opinion, you know, can I ask you, what does it look like if we pay off our house? What does it look like? And there's a number of things. Some of them are, you know, kind of nerve-wracking, as we'd say. Others of them, you know, maybe even awkward, but we're going to address some of those things today. So ready, set, go. Let's jump in.
So the first one that we have is, am I actually on track toward retirement or my financial goal, or am I behind? And actually, I think it ties in really nicely with the second question that we have. What's a good amount of money to have in savings for your age, income, and life stage? And I think that, you know, when we talk about embarrassing questions to ask your financial advisor, you know, it's probably not quite as embarrassing questions to ask your doctor.
Right.
But the reason why it's a little difficult and challenging for people, I think nobody wants to feel behind. And there's only so many things that, you know, I think a lot of times people think that, you know, things are out of their control. There's things like, you know, your own personal circumstances, the size of your family, your lifestyle needs, maybe the economy, things that really sometimes, a lot of times people don't have the sense that they can actually control these things.
Most of the people that we meet with are in and nearing retirement, right? So they're 55 plus, they're planning to retire, whether it's in 3 months, 6 months, or 7 years, they're getting close. And one of the things I hear so often is, you know, Trey, I put my head down, I started saving 5% of my paycheck, and then I push it to 7 and 10. And, you know, now we're saving 15 to 25%. But outside of just saving and watching the market do its job, I don't know what else is next. And I think one of the things that we help people figure out, maybe one of the nerve-wracking questions is, how long does my money last? So if I retire at 67, my wife retires at 65, we live on $10,000 a month, and we invest in a 60-40 portfolio, how long does the money last? Most people have never had that conversation before. And what's interesting is you and I meet with people that will show them, hey, when you're 90 years old, we kind of use that as a number for conservative planning. For some people, you know, they're going to leave $1 million or $2 million or $5 million or whatever that is to their kids and grandkids. But there's a lot of people that we meet with that their money only lasts maybe until 80, 85. And so one of the things that we talk about is, what's more important? Do you want to work longer to make sure that you can retire with financial peace? Do you want to lower your expenses? Do you want to invest more aggressively? There's several levers that you have, right, to making that money last. But what does it look like to start that conversation of, hey, if I were to retire today, do I have the option to? Yeah. The other thing I'd say is that we found a lot of people that we work with, once they find out they can retire, it actually makes it easier to go to work. Right. Now, as we've had so many people say, you know, if my manager makes me mad one more time, I can tell him I'm done, and I can actually be done. Yeah. You know, I had a client of ours the other day that came in, and he didn't bring his spouse. And he said, you know, basically my wife doesn't know, but I'm thinking about retiring 2 years early. And he said, you know, can I? And we went through his plan, and I just said, you know, to be honest, I said, you can't. Unless you significantly lower your expenses as your retirement planner, I would not be comfortable with you retiring today. And it was really good. He goes, that's not what I wanted to hear, but I'm glad I came in and found out before I retired. Yeah. And so one of the things I think about with nerve-wracking questions is, one of the things that we love at All Things Financial is when people come in and they say, hey, I'm thinking about doing this, instead of, here's what I've done, was it okay?
Yeah, and we're going to have a fair bit of that too. Here's what I've done. Is it okay? You know, and it'll be interesting to see what that guy ends up doing, right? Because we've given that advice to many people over the years, and a lot of times they just do what they're going to do, and they end up retiring anyways. And unfortunately, I think over the last couple of weeks, we've actually had to deal with the repercussions of that for one of our clients from many years ago that made some choices that we didn't recommend. And I think that, you know, for the younger folks out there, retirement just seems like a problem that's so far away. It just seems like it's so far out there. And if you just kind of fine tune some of the numbers for today, you might find that you're going to have to live more within your means. You might have to cut back. And those are the conversations that I think people would rather just assume that the conversation is so far away that they'd rather not make those changes today.
Well, I think what's interesting is probably the number one question that I get asked is how much money do I need to retire successfully at age 65? And almost everybody goes, I've heard that you got to have $1 million, or I've heard you have to have $2 million. And they always say a number, right?
Yeah.
And I think a lot of the families that we serve, they assume that $1 million is the number. And what's interesting is that we've got clients with $2, $3, $4 million bucks, and they're in trouble of running out just based on their expenses and the way that they live. But then we have clients that have $300,000-$400,000 in total retirement between both of them, but they live below their means. Their Social Security and maybe a small pension covers all of their expenses, and they actually are likely never to touch their assets outside of maybe a new vehicle purchase or some of those, you know, emergencies that happen every 3-4 years.
Yeah.
And so it's not just a number, but it's what are your expenses? What type of assets do you have? What do you want retirement to look like? And so we'll dive into some of that today.
Yeah, exactly. It's kind of like, you know, if you make $260,000 a year, but you spend $280, well, would you rather be that guy or someone who makes $80,000 a year, but you spend $60,000 a year?
Yeah.
Now, obviously, one person is living within his means, and most of us would say, hey, I'd rather have more money. But a lot of times, like, you know, what happens is the outgoings, they tend to keep up with the incomings. You don't just end up making a lot more money and all of a sudden you have all this extra money. I think the challenge is a lot of times people consider that extra money almost as if it's bonus or almost as if it's free money.
Yeah.
And they don't like, you know, they don't look at it as, hey, this is finally my opportunity to start investing and putting things away for retirement, maybe at a pace that is allowing me to keep up. They use that bonus as free money.
Well, I saw a post the other day for anybody that's on social media. Maybe they're watching this clip on social media, but if you go on Facebook or Instagram, almost everybody is specifically shooting to aim at the young audience, right? So I would say like you're 18 to maybe even 45 somethings. When they're talking about money and success, what are they showing you? They're showing you beach vacations, a sports car, and some sort of private jet. And I think what a lot of people realize the older that you get as well, you know, Ferraris are cool and private jets are cool. Really, the name of the game in life is stability and peace of mind. And I think the reason I bring that up is for most people, when they retire, they can successfully, if they've done a good job saving and putting money away for 30 to 40 years, they can live off 75 to 80% of what they lived on while they had two incomes. But if you want to live on 100%, or maybe like a lot of the people that we meet with, we find out that they want to live on 110%,
right?
You know, then your savings had to be different. And that's where we get into talking about the go-go years, the travel years. You know, have you started that? Do you plan on starting that in retirement? So those are some of the things that determine how much money do I actually need to retire successfully, which, you know, what we say at All Things Financial is retire once, retire well. But people always assume it's just a number.
Yeah. And, you know, Fidelity does have some numbers. I don't like to rely on these too heavily, but they do say by the time you're 30 years old, you should have at least one time your salary saved up. And I don't think that, you know, people misunderstand that. I think they assume that it means you can have that much in your checking and savings. They're saying outside of your liquidity, outside of what you have, but strictly what you have saved in retirement. So think 401k, IRA, pre-tax dollars intended or designed to be used in retirement. At the age of 30, you should have at least one time your salary.
Yeah.
By the time most people retire at 67, Fidelity recommends having 10 times your salary. And I know most people don't retire at 67, but that is full retirement age for the vast majority of people that are going to retire. Anyone really born after 1960, 67 is your full retirement age for Social Security. So I think that's why they use that number. But 10 times your salary at that age. And, you know, looking back at, you know, some of the clients that we serve and folks that we work with, it's a guideline, right? It doesn't match anyone perfectly. Nobody's going to fit perfectly into that box.
Right.
But it is at least something that maybe gives you something to strive for.
Let's say that we have somebody listening and they're in or nearing retirement and they go, hey, we've got X amount of dollars in the 401k. What percentage of our assets can we draw down and comfortably know we're going to be okay? So we have people say, you know, Yelisey, I've heard of the rule of 4%. If I've got $1 million, I can draw down $40,000 a year for the rest of my life. And hopefully I don't touch the principal, but at least that money's going to last. Does the rule of 4% still apply today?
I tend to reject all of these rules because there's too many variables that make a huge difference. So what do I mean by that? Like, yeah, the 4% rule was designed basically to let people know if you don't touch more than 4% of the value in your retirement savings, you should have enough to make it through retirement. You won't run out of money. But like you add a few things in there, like your expenses, if they change drastically due to like things related to healthcare
Right.
or inflation, right? If inflation goes up, I mean, think about the fact like whenever we change somebody's expenses, let's say they're $5,000, but we're like, maybe they're $6,000. Why don't we play with the numbers a little bit?
Yeah.
The outcomes are so drastically different.
Right.
So looking at 4%, well, 4% assumes nothing about what's going to happen in the market over the next 30 years. We could experience something like the lost decade where we had 2 corrections in a 10-year period. And if that's part of your retirement age or your retirement years, well, 4% is going to be it's just very difficult to judge on that. But the biggest factor that challenges the 4% rule is longevity. When the 4% rule first came out, I don't think they were assuming people would be living well into their 90s.
Right.
And that's something that is difficult to account for. If you're taking out 4% consistently year over year, you throw in a few corrections in there, you have inflation, you might have to increase that dollar amount, you might be in trouble.
So if someone said to you, I'm trying to decide how much I need for retirement, you don't know anything about their expenses, what's the first 2 or 3 things that you would say to that person for them to have an idea of the number they need to hit? Would you say that if you use the rule of 4, you can depend on that? Would you say for every million, you can, plan on pulling 30,000 and that's comfortable? Just give people some rough numbers. I won't hold you to this.
Yeah. So I haven't thought about rough numbers, but what I would say is if I'm trying to be comfortable in retirement, like at least how I'm trying to set myself up in retirement, I want to make sure that I can weather the storm. That whatever percentage I land on, like probably I'd want it to be less than 4%, but also like I need to know like what percentage of my budget is represented by lifestyle. And that's really the one thing that I think, there's a term I heard, I don't know if you've heard of this, it's called lifestyle creep. It's when your lifestyle begins to become a much bigger line item on your budget than it should be. And that's where I think a lot of folks get into trouble. So anytime we ask somebody about their expenses, a lot of times they're thinking about like their fixed expenses.
Right.
And when we actually get to the bottom of it, they're spending quite a bit more than that. And if your lifestyle represents 20, 30, or even 40% of all of your monthly spending, like the nice thing is you can adjust for that.
Right.
The not nice thing is nobody wants to adjust for that. That's the last thing anybody wants to consider. And I think that for me, like I'd have to know like, hey, how much of this is absolutely necessary? This is what I need to get by on. And how much of it represents my lifestyle? And I think I might expand the lifestyle line item on my budget in years where the market's doing really well, in years where I'm doing like a one-off thing, like a fancy vacation that I don't plan on doing every year. Like maybe it's a big trip to Europe. Like, okay, fine. We're going to make some concessions and maybe we're going to do more than 4% in that year. But I always want to return to my baseline, I think. So it's I don't want to say like a hard and fast rule, 4% or some percentage number. There are going to be some carve outs and some caveats that I think are important to have.
I would say kind of leading into our next point, what should I expect from a financial advisor if I'm paying a fee, right? Yeah. So I think it depends because on average in the United States, we see people pay fees anywhere from 0.5% up to 2%. I'd say 1 to 1.5 is kind of average. And I think historically, if you've been in your accumulation years, what paying 1% or 1.25%, 1.5% does is it gets you an advisor that's hopefully choosing better funds than you could choose. Vanguard has a study that basically they say if you hire a professional manager, that you can expect them to return 1 to 2% more than you would after their fee.
And they break down every item from diversification to rebalancing. And they actually, obviously they're using some assumptions here too, but
right.
They're assigning a dollar amount to what you can expect over time. And yeah, it was actually
a great article, yeah. Right? And I think it's really helpful to someone that says, is the value worth the cost? One of the things I would challenge people is, even though I do think that's true, I think Vanguard did a good job not just selling it based on a sales perspective, but bringing up important facts, is that as you get closer to retirement, even though having a financial advisor grow your assets while you save those assets was really important, in my opinion, what you need from an advisor changes in retirement.
Yeah, definitely.
Now you need that money to grow. You also need somebody that knows how to protect it when the market is down. Yeah. You need somebody to help you forecast how long the money's going to last. You need an advisor that says, hey, I want to help you enjoy your money, but if you're making decisions that are not for your benefit, I'm also going to say to you, I don't think this is a good idea. And so I think there's a lot of value in paying an advisor to make sure that you are not making any costly mistakes. I think one of the things that's surprising to me is how many people will spend 40 years saving well and then they'll make a couple significant mistakes that impacts the rest of their retirement when they had enough. But had they just had the right person, the right coach, the right alignment, they would have been okay.
What do you think is that difference maker? I feel like, I can give people advice all the time, but even on my own dollars, on my own investments, like sometimes I'm making my decisions are a little bit more emotional, and I feel like I know I wouldn't give that advice to a client, but I really feel a certain way about this. So I'm going to make a decision that I wouldn't stand by in a client setting.
Yeah. Well, I would say, a lot of financial advisors have a financial advisor.
Yeah.
And the reason for that is because just what you were saying, most people are more emotional with their own money than they are with somebody else's. And so I would say that if you're thinking of hiring a retirement planning advisor, when you're paying a fee, here's what you should get out of it. You should get somebody that has spent over a decade, in my opinion, that's helped people in your situation. So if you have an advisor that works with 18 to 80-year-olds, there's nothing wrong with that. But wouldn't it be nice to work with somebody whose average client is your age, has your assets, and has walked dozens and dozens, maybe even hundreds of people through what you're about to walk through? So I would say look for a financial planner that falls in line with what we'd call a home office. What is that? They do investments, they do taxes, they do insurance, they can help you with estate planning and anything else related to retirement, all things financial. And so I would tell people, if you can get to a home office, then instead of having to be the middle person, you can actually have an expert who's your quarterback that directs you to qualified people to help you in all those areas.
Yeah. And just to clarify, like when you say tax planning, you're not talking about preparing someone's tax return. I mean, that could be something that is also part of the deal. But when we talk about tax planning, like in my opinion, like that's the biggest difference between having enough money to last in retirement or running out along the way. And I think that that's, obviously for someone who's maybe in their 20s and 30s, it's tough to assign a value to something like that, especially when you're just simply plugging away and just making those contributions. But yeah, I think that, when I hear that, that sentiment, why do I need a financial advisor? What exactly am I even paying for? Like, you're just going to tell me how to spend my money. Like it's possible that someone can go out there, they can DIY it. They can, listen to a few talks, learn how to put together a couple spreadsheets, maybe download some software. It's possible they can do that. But I think that a lot of what we do is more than just the numbers. Right. I know that sounds like a nice thing to say, but it really is more than just the numbers. Think about how many times like we're preventing mistakes because, someone is looking to make a rash decision because the market sneezes and they're looking to panic sell everything.
Right.
Or we have somebody who's coming in and they're comparing their returns. Like I'm thinking of one person in particular, but they have a lot of individual stocks, or someone who has just a bunch of tech stocks and maybe, some cryptocurrency that's named after their favorite dogs, but it's like, hey, the diversification piece is really important in that scenario. And that's going to save that person potentially some huge losses.
Well, what I think is really important is that when you work with a financial advisor, that you know what you want to get out of that person. Yeah. So what I tell people all the time is what we do at All Things Financial is we help people retire once so they can retire well. So what's a practical piece to that? If you are preparing for retirement and you need help with Social Security, you need help with health insurance, Medicare, you need help knowing, hey, I've got all these different investments. I've got IRAs that are pre-tax. I've got Roth accounts. I've got brokerage accounts. Where do I pull from in what order? Most of the people that we work with have a great advisor on the accumulation side, but they've never worked with a retirement planning specialist. And what I would say to them is you might have a great family doctor, but if you have a problem with your foot, what do? You go to a foot specialist. And so when you pay for a financial advisor, what you should get is somebody that specializes in the season of life that you're in so they can help you ask the questions that you don't even know how to ask. And so one of the things I love is, our retention rate over 8 years is over 98%. And it's not because we're perfect. Anybody that knows me, and especially you,
I was going to say that. You beat me to it.
knows that we're not perfect, but we're genuine. We work really hard for people. And we have a team full of people that are mission-minded, put clients first, and that are very skilled at what they do. So what I would say is in life, one of the keys is to surround yourself with people that are already winning in the areas that you want to win. Mm-hmm. And when I look at the cost of a financial advisor that cares about you, that has a great track record, and that takes you out of being the middle person, they are worth their weight in gold.
Yeah. And to kind of sum it up, I would say that the things that we offer is we provide accountability, right? We help you stay on track. Emotional restraint, that's a really big one, especially with the market, the way it's been fluctuating over the last couple of years. And also just helping you stay the course. I think that's a really big one. I think people are in different seasons of life. It's not that it's easier when someone's in the accumulation stage of life, but there are fewer questions to answer in many circumstances. And I think that the most critical ones come down to retirement and making good, small decisions over time that really do add up to a big difference.
All right, number 5. What's the difference between all these accounts? So it's interesting is we run into people that they've been great savers, right?
Yeah.
And then when it comes to their accounts, like we have a lot of families that we serve, they go, man, I'm an amazing scientist. Other than saving money, I know very little about this. So when we talk about different types of accounts, just take a minute or two. And if someone were to say, hey, pretend like I don't know anything, and some people don't, right? And that's okay. But talk through the different types of accounts and what those look like and how it should impact where they pull from in what order in retirement.
Yeah, so there's a lot of different accounts to cover, and I think just for the sake of simplicity, I'm going to say pre-tax accounts, and a lot of times those cover all of your employer-sponsored plans. These are typically categorized as qualified accounts, even though there are some employer plans that are considered non-qualified. So the benefit of having a qualified plan, a pre-tax account, is any dollars you put into that account, they're not being taxed, right? You have the entire gross amount to work with. In fact, a lot of these plans are referred to as deferred compensation plans.
Right.
Because you're deferring your compensation. You're saying, I'm not taking the income home. Instead, I'm going to put it into this type of plan, typically a 401k, maybe a 403b plan, and those dollars will be used for retirement eventually. But eventually, when you do pull the money out, all of those dollars are taxed at ordinary income rates.
Right.
So the idea is, hopefully in retirement, when you actually retire, your income is going to be quite a bit lower and you'll be able to pull those dollars out at a much lower rate. That's a big question mark, right? Because we don't know what's going to happen to rates in the future. We don't know any of these things, but we hope that because our income will be low enough, probably that's going to be what happens. So you defer paying taxes. You actually lower your tax bill in this specific year. And then eventually after the age of 59 and a half, there is no penalty to pull the money out. You simply have to pay the taxes. Yeah. So that's probably the most popular plan that's available to
most of the people that we meet with. Have the majority of their life savings in a pre-tax account.
Yeah. And I would say that, aside from like home, cars, different assets like that, I mean, that is where most people, where their net worth is wrapped up into that.
So if someone's listening and let's just say they've got $500,000 in their 401k, their spouse has $500,000 in her 401k. So they've got $1 million of pre-tax dollars.
Yeah.
How much of that is theirs?
I mean, it really just depends on how long it takes them to pull the money out and what their other income sources are.
Give us a range.
But I would say probably for most people, I would say they're giving up, whenever they pull money out, 20 to 30 cents on the dollar to federal and state taxes.
Yeah. So if you have $1 million in a 401k and you're listening, if you got $1 million in retirement, 30% of that approximately probably isn't yours.
Yeah.
The government just hasn't taken it yet.
Right.
And that doesn't include required minimum distributions. What is an RMD? A required minimum distribution. If your advisor hasn't talked with you about this and you're past the age of 55, this conversation is a little late, but it's important. Your RMDs is when the government has said, hey, Yelisey, hey, Alicia, we've allowed you to put this money away, grow it tax-free. All of a sudden, you've hit this magical age, which for you and for I would be 75 years old today. And now we're going to force you to take out a portion of those assets. Typically, it comes out to around 4%, and then it grows every single year.
Yeah. So
what a lot of people don't realize is that even though they don't need the money, they're going to be forced to take it. So on top of the 25 to 35%, if you don't have a good tax strategy, you could be giving up closer to 40% or more of these dollars you've spent your whole life saving. Can you touch on that?
So I had someone who recently came in the office, and his big concern is his wife, who it seemingly is going to be, she just has a lot of health challenges. And he's really worried because her portion of the income, the household income, is just a very small Social Security check. The vast majority of the income is his pension and his very large Social Security check. So if she were to pass away, he's going to go from the broader married filing jointly brackets to the single tax brackets. And when he enters the single tax brackets, especially when he hits RMD age, he's going to have to pull out an additional $75,000 in required minimum distributions.
Wow.
What happens for him, unfortunately, is something that happens to a lot of people. Maybe the scenarios are a little bit different, but now he has to pay more for his Medicare Part B premiums, his Medicare Part D premiums. Now his Social Security on the state level will also be taxable too. and he's entering a higher tax bracket. And if it happens over the next 4 years, he's going to lose the senior tax deduction, the one that recently was passed for anyone over the age of 65, who gets an additional $6,000. So you can see for him where it's like, hey, we have a couple of years to plan. There are some variables, some unknowns that we have to work through, but it's not uncommon to have these types of challenges and really not having anyone to turn to that has actually dealt with these things, unless they also provide the tax advice, the tax planning, and not just, looking at retirement as a pie chart, making sure you have the right investments. Another case for why you might need a financial advisor.
If somebody were to ask you, Yelisey, I've heard all about Roth conversions. How do I know if I should execute one or not? And what are the pros and cons? Your response is what?
I would say that it really just depends on your objectives, right? It's always better to have more money in Roth. Like that, if you could pick, that would be the best place, the best vehicle for your money, because you pay the taxes on the front end, but you're never going to be taxed again. In other words, it could stay there for as long as possible. That account can grow to any number you can imagine, potentially, and you wouldn't have to pay any taxes as long as you followed the guidelines regarding distributions. So I think that's a very powerful vehicle, especially if taxes are going to be a problem in the future. But also you could pass it on to your children, and they wouldn't have to pay anything in taxes when they distribute from the account as well. So, a case for the Roth IRA, the only case against it potentially would be in the earlier years when you're still working. If you are in a higher tax bracket, you might be better served to lower your tax bill by putting it into an IRA, a traditional IRA, or maybe an employer plan, because that lowers your tax bill in that year. If you put it in the Roth IRA, you're typically working with fewer dollars because you've given a portion of those dollars to Uncle Sam, and what's left is able to go into the Roth IRA. So you're starting with a smaller amount to begin with. So I don't know if I answered your question, but those are kind of the pros and cons.
Yeah.
If anyone could pick, you would put all your money in a Roth, right? There's just a few things to consider.
Super helpful. Question number 5. What do I do first? Do I invest or do I pay off debt or save cash? I'm going to answer and then you can answer.
Okay.
When somebody asks me, do I pay off debt or do I save the cash? I would say that from an engineer's perspective, you just look at the interest rate.
Exactly.
Right? So your house, you've got a mortgage, it's at 3% and you're averaging 12% returns. Why would you ever pay that down unless the peace of mind is worth more than the 9% that you're making per year?
Yeah.
And there's variables, right? Just because you've made 12% a year the last 5 years doesn't mean you will going forward, but maybe keep the mortgage until you find that changes. However, but we have people that would say, even though I know mathematically and based from an engineer's perspective that I shouldn't pay the house off, if I sleep better at night, should I pay it off? And sometimes the answer is yes. Because while we talk about investments and taxes and Social Security and Medicare, and there's all these different pieces, at the end of the day, really what we're doing is we're helping people have complete financial peace. And so for those that say, do I save the cash? Do I pay off debt? I would say it's better to pay off debt a little slower if it means that you keep an emergency fund that gives you peace. From an engineer perspective, what does it cost you to not knock out the debt overnight to keep some money on hand? But then also, what's going to give more peace to you and in your home? How would you address that question?
I look at things like debt or things like, it's almost like a conversation that you haven't had closure on. It's almost like an open loop in your life. And I feel like I have so many of these things going on and it drains me. It gives me anxiety knowing that I haven't closed the loop on this or on that area. But then I look at the numbers and it's like, hey, if I'm paying 3 or 4% on my debt, but I'm easily making 7 to 10% on my investments, well, I'm going to make the calculated decision and I'm just not going to pay off the debt.
Yeah.
Right? Because it's a no-brainer. And I think that for a lot of people, it really depends on a few things, right? What kind of debt is it? There's consumer debt, like credit card debt, where I would say like, hey, it almost doesn't matter. The wiser decision isn't to invest the money. It's to get rid of that revolving debt.
Right.
That could be crippling you and you're probably paying north of 20% to keep that debt.
What's the worst financial habit I have that I don't realize I have? So when we meet with people, one of the things that we find is a lot of everyday blue collar, wonderful people. Yeah. That's the way I grew up. Most of those people, they have all of the pieces for a successful retirement plan, but what they're missing is the plan. And what I would say is I show a lot of them that they are only $500, $600, maybe $700, $500 to $700 a month away every month for the next 20 years. They're only $500 to $700 a month away from either having total financial peace or ending up in financial ruin.
Right.
Because what they don't realize is that extra $600 a month is $7,200 a year that isn't making 10% in the market.
Exactly.
And so now they are literally, instead of their retirement lasting until they're 90, they run out at 81 or 82. And so I think the biggest thing that I see is we run into a ton of people in their late 50s, early 60s. They still spend an extra $200-$300 a month because their kids are on their cell phone plan. They have 2 car payments instead of having 1 car payment at a time, which I think, if you're listening, one great way to get ahead is if you like nice cars, have 1 car payment at a time, pay the other one off, and then shift. A few simple things. Kick your kids off the cell phone plan.
Yeah.
Don't eat out as much, and knock out one of your car payments. So there are a few things away. I see a lot of those as bad financial habits. One of the big things that I would tell everybody is anytime that you get a raise, before you go and increase your lifestyle, new car, new house, spend 4, 5, or 6 months with the extra money to see if you want that new car bad enough, or if the extra cash in your account, the extra savings, if the peace of mind is worth it. Recently had a conversation with a friend, and he was saying, man, I found this house. It's only 5 minutes from work. And if I didn't have to drive 25 minutes from home every day, I could stop and see the kids. My wife wouldn't have to run to sports and drive the extra 25 minutes. It'd be huge for our life. And his wife said something I thought was really wise. She said, as much as I'd love to live closer because of the interest rate that we have, she said, I would rather stay where we're at and have more fun money because I feel like since we've bought the last house, we are house poor. And so I'd say one of the things that I see people do is they make a big purchase like a home or a car that they can't correct that decision because now they're stuck. So one of the biggest mistakes I see people make is as soon as they get an increase, they make a commitment for those dollars, and now it doesn't feel like they ever got the raise.
There's a big difference between most anyone who's married and or maybe not even your spouse, but think of your parents and did they see eye to eye on spending? There's probably one parent who was trying to stay within the means and then within their means, and then the other parent who probably had the idea hey, when you're dead you can't spend it,
Right.
And that mentality. It's not right or wrong either way. There's probably the balance is probably the correct answer here, but it's tough. I'm trying to think what's a bad habit that you've probably developed, not you, but
Yeah.
someone. And I think I agree with you. And I alluded to it earlier that whenever you experience a financial windfall, just spending through it, considering looking at it as if it's free money, as if it, that might be the opportunity you needed to actually get ahead.
Right.
And I know that you've talked about having some friends that for them, their problem was income. Right. They had a certain number of kids. They had certain expenses. There's nothing outlandish. There's nothing that
they didn't have a
was out of the
spending
norm.
problem. They had an income problem.
I think most people have a spending problem. I think that's rare.
For
I
sure.
think that example applies to a very few number of people. Most people are just going to spend it. I mean, you think about a house today, you're probably $400,000 might be your starter home
Right.
today. So if you consider how much money you're going to need for that after you factor in a down payment,
Right.
I know
20%.
20%. So $80,000 will have to go towards a down payment.
Yeah.
I know some people, they probably
Closing
only put down
costs.
5 or 10%, but I think
Yeah.
most people are at 20% to avoid the private mortgage insurance.
Yep.
Closing costs, you're easily at $100,000 that you need to come up with. But the reason why it's important, what you just said, if you look at all of your expenses, and I think the number you came up with was $700. If you can cut out $700 a month, not only are you putting away $700 a month, but that's also potentially growing at 6 or 7%. You might look at a house that's $400,000 and it seems like it's so far out of reach. But if you just put away $700 a month, if it's growing at 6 to 7%, you're probably 5 years away from coming up with the resources you need. It's much more attainable than you think it is, especially if you can find the discipline to do that.
What's one change I can make this month that would have the biggest return on investment? So if somebody's listening and they're like, hey, so I've listened, people have asked all these questions. We've kind of ended talking about expenses and assets.
Yeah.
The biggest thing I would tell people kind of going back is it's not the one-time things, right? So if you go make a big purchase, as long as you don't have to purchase it again next month, it's pretty easy to recover from that. It's the reoccurring purchases that I see people get stuck. The car payments, the house payment. I recently was speaking at a leadership event and I had a super sharp guy, my age, mid-30s. He came up to me and he said, hey, Trey, he said, can I ask you some questions just about finances? And I said, yeah, of course. And he said, my wife and I bought a home 5 years ago. We bought, it's a new build. The builder had this special where your first 5 years, basically the interest rate was 3.5%. And then in 5 years, it would just refresh where it's at. And now it's 7%. So he said, our interest rate went from 3.5% to 7%. So we got into the house and basically, we were at the top of our budget. And now our mortgage is about to jump a couple grand a month. And he said, well, what do you think we should do? And I said, well, let me ask you something. I said, what percentage of your take-home pay, of your income, is your mortgage? And so he's sitting there, and we're standing in the middle of a conference room, and he goes, our mortgage is 54% of our monthly take-home pay. And I said, well, just so you know, as a financial retirement planner, that number should be closer to 20 to 25%. And what experts recommend is it should be 33% at the very most if you're kind of stretching for that family home and you're young and you know that your income's going to grow. So I said, you're twice what I think is comfortable. And what a lot of millionaires have done is they've actually spent less, where their mortgage is 10 or 15%. So I said, unless you know that you or your wife has a big raise coming or some significant commissions, I don't think you're ever going to have any fun money. And he goes, we don't. He goes, it's so tight every single month. And I said, I think it's more important that you actually have some fun money than you spend 54% of your income on a house. And I said, you guys don't have kids yet. This should be the time that you're traveling, that you're playing, that you're having fun. And so I said, now, obviously, it's not going to be exciting for your wife that we had a conversation, and my recommendation is that you sell your house. Yeah. I said, but if you have to downsize for a couple years so that you guys can enjoy the journey, still own something, but enjoy the journey and not give up over half of your income to a house, you guys are going to have a better life. Whenever you go to buy a house, think of house shopping in general. You're walking through a real estate agent. You're dreaming about having your life in a home. And that home is supposed to be a source of joy for you and your family. Yeah. And now it's the opposite of that. Right. Or whether it's a vehicle that you've overextended for that. It sounded awesome pulling off of, the dealership lot, but now it's your first brand new car, whatever, but now it's a source of pain and struggle. And now you don't have any more positive emotions that are associated with that item. And you don't want to be in that position. One of the things that I'm a big believer in when it comes to, finances is when you make decisions, make sure that you've got your spouse included. Everybody that we work with, it seems like there's a saver and a spender. And one of the things I will say, women, if you're listening, is spenders. That you're talking about the spenders now, right? Well, I'm talking about both, actually. Here's what I would say to a lot of wives. We get a lot of women that'll say, hey, one of the things that's a challenge is that my husband doesn't like spending any money. And even though I'm on the side of enjoy the journey, I'll say, as hard as that is, it's better to be the wife that says, or maybe you're the husband that says, my wife won't spend anything, than to say my husband or wife spends it all and we don't have anything. Yeah. So if you're going to err on being more conservative, because we run into couples all the time where more often than not, he's a significant spender. Women like stability. And now he'll retire because a lot of guys are okay living in a van down by the river if they had to. Yeah. But the wife will keep working because she wants the insurance, she wants the peace of mind, and she married a guy that was okay not having it. So I would just say that if you're listening, it's better to err, on being conservative so that you have the option to retire someday than to be the spender that's always pushing your spouse. So if you're choosing between two extremes, choose the more conservative route. Yeah. I mean, it hurts saying that, but I agree with that. Also, don't pick the extremes. Hope your day's great. We'll see you on the next one.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC, are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.